Yo, Adrian, what do you think about this? Hello, welcome back to Southwest Florida Unlocked. I am Adrian Bray. I am brokered through Real Brokerage. All opinions are my own, and they are plentiful. So let's get into it, shall we? I have not been this fired up, I think, since my last video. Wall Street Journal said that Cape Coral was the worst housing market. It was very much clickbait. Check out that video for my debunking of all things from that article. But this one I actually think is a lot worse because the ramifications of the decisions that people could make in choosing to do this are like pretty bad, honestly. Announced 50-year mortgage. OMG, Becky, what are we thinking? It's being advertised as a way to make home ownership more affordable. But what does this mean, and what are the ramifications of a 50-year mortgage? So I thought I would do what I normally do, which is be super nerdy, go through and really look at it from a strategic lens versus just a pure emotional lens and having an opinion, but it's an opinion based on what? In this case, we're going to go ahead and take a look at literal numbers to see why I am so fired up and why the propaganda that will probably be put and spun on this is going to make me even more angry. And we're going to walk through a spreadsheet that I created. I'll put a link somewhere as well so that you can get this spreadsheet. I just really want people to understand what we're getting into. Let's just start with some basics. So if we're looking at typical loan packages, you usually have a 15-year or a 30-year. A 15 years obviously paid off in 15 years, a 30 years paid off in 30 years, duh. If we're gonna now add in the 50-year, then we add on an additional 20 years. Let's take a look at kind of loan type by loan type and walk through just the portions of it. If you already understand this, or if you've purchased a home before, just kind of hit the little, go forward a tiny bit. But for those who haven't, and this is probably quite a few people, because at this point, I believe the average first-time homebuyer in the United States is, I think, 40, which is just bonkers to think about, that there are people, the majority of people are not going to be building equity until they are in their middle age. I mean, obviously 40 is young if you are not older than 40, but that's a sidebar. What you're looking at on this particular screen is my tab entitled 15-year schedule. So just a basic, I'm not a loan person, by the way. This is just me as a licensed realtor and my understanding of the way loan amortization works. So obviously seek out a lender or a professional licensed person for actual numbers. That's my next disclaimer. Let's go ahead and take a look here. So I have in my numbers, $450. That's hilarious. $450,000 as the purchase price. And then when you purchase a home, you are required to put down some sort of down payment as determined by your lender. In this first example, we're going to use 20%. 20% is kind of the old school number that people always assume you need in order to purchase a home. That's not necessarily the case, and actually quite often that's not the case for, in my experience, the majority of people are not doing a 20% loan. They have some other type of loan package that's offered to them, but we're going to go with 20% for now. So we've got $450,000 purchase price. We have a 20% down payment, which is $90,000. The difference between that $450,000 purchase price, the $90,000 that you are putting down, so out of pocket cash or out of pocket, brings your total loan amount to $360,000. The current market rate ballpark is 6.3%. Now this percentage will differ based on if it's a 15-year, a 30-year, assuming a 50%. But for right now, just so you guys can see apples to apples, I'm going to use 6.3%. And then on this particular tab, we have 15 years. So you have 15 years to make all those payments. Here. Anyway, you take your payment amount and then you multiply it by 15 years, 12 months in the 15-year time frame. You have 180 payments plus the interest, which equals this $3,096.54. Now let's go down here. So on your first payment, again, the total is $3,096.54. But of that, you need to look, or a portion of your payment will be paid towards that interest. So in this case, we've got, there we go. That makes it easier. So we've got our loan amount times the interest divided by 12. So divided by 12 months in a year. So your first month's interest is going to be $1,890. The difference between your total payment and that interest is $1,206.54. So basically what that means is of your total $3,000 monthly payment, $1,200 goes towards your principal, so goes towards bringing down that total loan amount of $360,000. The rest the bank gets to keep because they gave you the money or loaned you the money in the first place. So that's what interest is. Banks make money off of your giving you that full amount up front, and then you pay them a payment or interest. Excuse me, interest. So again, simple math here. You started out with a loan amount of $360,000. After you've made one payment of $3,000, you are now down to $358,793 and some odd change. So roughly, of your $3,000, you've actually paid down $1,200. So you're down, approximately that $1,200 on your balance. So that goes all the way down 180 payments later. So at the end of 15 years, you will have paid $197,000 to the bank in interest. There's your full principal, $360,000. So that was your original loan amount. So total in 15 years for a $450,000 house at 6.3% interest with 20% down, you will pay $557,377.41. Now take this exact same scenario at the top. We're not going to change anything, but we're not going to change anything except the loan length. Now I'm going to jump over to my 30-year just because, so as you can see here, it ends at that payment amount, this 180 payments, but then I stopped it here. It'll make sense in the future. So I did this exact same tab, but now I added and made it 30 years. So again, everything is the same up here. We've got $450,000 purchase price, 20% down, which makes it a loan amount of $360,000, 6.3% interest, but this time instead of 15 years, it's 30 years. And because your payments spread out, your monthly house payment is lower because instead of spread out over 15 years, 180 payments, it's spread out over 30 years, 360 payments. So now your monthly payment goes to $2,228.30. So that's why people will pick a longer term, which is what we're being sold on this 50-year, kind of to sum it up at the end, is that your monthly payment is going to be less, making homes more affordable. So for 15 years, again, your payment was $3,000. For the 30 years, your payment is $2,200. So again, we do the interest, how much is going towards your principal. Here's your balance. As you can see, because it's a longer term, you've got a higher interest to the principal, or compared to the principal. So let's go all the way down. So, hold on. One other thing. This is interesting as well. So if you take that 180 mark right here, so on the 15-year, you're paid off at that 180th payment, and you have paid, again, that $567,377. If you go to that same 180th payment, so 15 years down the road, because it's spread out further, you are now only at you still have, I should say, I'm sorry, I said that wrong, a balance of $259,000. So you got a long ways to go at this point because you have another 15 years of payments. So that same house purchase price at that same interest rate now becomes $802,000 that you've paid. So again, for the 15-year, you will pay $557,000 roughly. At the 30-year, you will pay $802,000. See where we're going? Let's take a look at this again. Exact same scenario, but now we're going to change it to a loan length of 50. So again, the only thing that we're changing from these numbers here is our loan length 50. And again, because we changed the loan length, our monthly payment goes down because we're dividing the loan amount by 50 years worth of payments, which now I can't remember what that amounts to. It's like 600 payments. We'll see in a second. Divided by that number of payments instead of the 180 or instead of the 360. Blah, blah. Okay, so again, at 15-year, your payment is $3,000 a month. For the 30-year loan, your payment is $2,000. Again, I'm rounding here. And then at 50-year, rounding, $2,000. What's the actual difference? So 30-year, it's $2,000. Here, I'll do a little figure rating. Equals minus. So saving $252 a month by going from the 30-year to the 50-year. I can do the same thing for the 15, but that's bonkers to just jump into. Anyway, so for the monthly payment of $1,975.35, let's see where we end up. So let's first take a pause at the 180, so the 15-year mark. So at the 15-year mark, which is right here, you still have a balance. Again, you've been paying for 15 years at this point on $360,000. You have $334,000 to go. Whereas at the 15-year, again, you're paid off. You've paid $557,000. Yeah. Okay. So that's crazy. So then continuing on to the 30-year, the 360th payment mark. You still have $269,000 left to pay off. You've been paying for 30 years at this point. You've paid off a little over $100,000 in 30 years. So what is the total that you would be paying should you pay this loan off in the full 50 years? You would be at, I'm still scrolling, 600. Okay, I was right at 600 when I was going to say that before. Anyway, so for a $360,000 loan starting point, 50 years later, you will actually have to pay $1.185 million. The bank makes $825,000 on a $360,000 principal. It gets worse, but let's just take a pause there. Like, what? It was already bad enough, right? The bank made 400, almost double, or I'm sorry, a little more than double on that same loan at the 30-year mark. And then let's just go back here. So they make less than that, obviously, at the 15-year mark. But for 50 years, you will have had to pay $1.185 million. And if you think about the fact that the average first-time home buyer is 40, they're going to be 90 years old by the time they finally pay this thing off at $1.185 million. I have more. So you can see I have obviously more tabby tabs down here. So if we go back to this 15-year schedule, I also have the same information Now bumped out with even more information. I told you it was nerdy. It was super fun, right? So in this, what you're looking at here, this is an amortization. I always say that wrong. Schedule paired against the potential equity that you would be having. So that's the whole, in essence, the whole point of owning your own home is you are building wealth. You're building equity in something tangible that you're going to be able to have, worth something at some point. So that's what you're looking at here. So again, we have the beginning balance of that loan amount at $360,000. Just for the way this works, you start at month 0. So at month 1, again, that same number, that $358,793, we saw it on that first 15-year schedule at the very top, just so you can see that, right? So those numbers are the same. But now at this point, we're going to bring in what the home is worth. So you bought it for $450,000. That's a purchase price, and we are doing a very, I guess I would call it, I would say a conservative appreciation rate, but it's kind of averaging out the highs and lows over time. So I'm using 2%. Obviously, sometimes houses appreciate way more. Other times you are in more of a deficit. Think like the market crash of back in 07, 08. Some of you have no idea what that is, which makes me a little bit old and depressed feeling, but whatever. All that to say, I'm using 2% as my appreciation. So after 1 month, the home, in theory, has appreciated to a value of $450,743.21. You take that amount minus what you owe still on your home, and this is what you have, in theory, in equity. And the reason why we have a net positive is because we have put money down. So that $90,000 is your equity to begin with. So your loan balance is this column here. So you have a loan balance of $360,000. So by the time your loan balance reaches 0, where you've paid it off, all that time, again, this is in theory, not a guarantee or a promise, as the disclaimers on commercials say, we've been appreciating 2% on that initial $450,000 purchase price. So the home value increase, in essence, you're at $605,000 at that 15-year mark. So same thing at the 30-year, except this time, instead of stopping at 180, we go let me do one more thing. This actually is good too. So if you have the 30-year loan at that 180-year mark, just a sec, let me go there. So again, your balance on your loan at the 15-year mark, 180 payments later, is 0. When you're at the 30-year, so halfway through, you have a balance of $259,000. So you still have $259,000 left to pay on your loan. So the home value has reached $605,000 right here. In this case, though, because you've paid off your home, you have the full amount of equity available to you, $605,000. But in the 30-year scenario, you have at $605,000, the home value would still be at the same value at that 30-year mark, but you still owe money on it. So you take the full value less how much you owe on it. So you have an equity in your pocket at this point of $346,000 at the 15-year mark on the 30-year mortgage note. So this person here, same price for the house, they now have, in essence, $605,000. It's not in their pocket because they would clearly need to sell and whatever, but $605,000, they're worth $605,000. The 30-year mortgage person is worth $350,000. So that's quite a huge difference, correct? Correct. Before I go all the way down, let's do the same thing and stop at the same point of the 15-year point, because I think that will be helpful within the 50-year schedule. All right, so again, remember, everything's the same. The only thing that's changing is the length of the term, which of course changes your monthly payments. So again, same here. We start with that balance of $360,000. the home is valued $450,000 plus that 2% appreciation. So your equity at this point is, right here or about, it looks the same. But what we need to look at in the end is how much we're paying off that loan, the difference between that and what the home is valued at, what it's appreciated towards, and then that becomes your equity in your pocket. So at the 180 payment mark, which is, we're almost there. I have it highlighted. Oh, that was so good of me. So for the 50-year, excuse me, got all verklempt. The 50-year mortgage at their 15-year mark, again, the home is still appreciating in value, but at this point, they still have a balance of $334,000 on their mortgage, meaning in their pocket after 15 years, they have $271,000. So again, let's compare. The person that has the 15-year, they have $605,000 in their pocket. The person at 30 years has $350,000 in their pocket, and the 50-year has $271,000 in their pocket. And scrolling down to the 30-year mark to do that comparison, 30-year mark, we have $545,000 in equity. At that same point in time, the equity is $1.2 million for the 30-year. Okay, so the next thing to explain what these numbers down here. So the house is going to be at the way in the future mark at the 50-year mark worth, again, we're just doing all things guesstimate, who knows, with that appreciation rate of 2%, $1.2 million. The 15-year mortgage should they still own that home at that 50-year mark, the home value is $1.2 million, and if we take away what they paid originally, which was $197,000 in interest, $360,000 of the principal paid back, they see $653,000 like real dollars. When compared to the 30-year, doing that same thing, the house again is still going to be worth $1.2 million, same appreciation of that same home. But they paid for their 30 years of payments $442,000 in interest plus the original principal. So you take those two numbers less what the appreciated value is of that home. They see kind of the real money of $409,000. The 50-year mortgage, scrolling all the way down to the bottom. Again, home worth $1.2 million. They paid $825,000 in interest, plus the $360,000 they paid for their actual principal. So they, in their pocket, after 50 years, have $26,000. $26,000 comparatively to $653,000. Yep, seems like a good idea, right? Let's look at this some more, shall we? Basically, I'm taking that same information and now instead of doing it to what the appreciated value is, just literally like dollar for dollar. So this is the 15-year person. They're not going to have to worry about these two rows of information. This is the 30-year, so they don't need to worry about the 50-year mark. Here's the 50-year mortgage, so obviously they do. So 15-year, all the information we had before, we're just showing it differently. What we want to look at is over here. So they paid $197,000 worth of interest at that 15-year mark. Here's where it gets even more interesting. At the same 15-year mark, but because the 30-year mortgagee has their payments spread out over 30 years worth of payments, obviously you accumulate more interest because the interest has more months to be divided on. So at that same 15-year mark for the same loan at the same purchase price at the same interest rate with the same down payment, but with 30 years instead of 15, this person pays $300,000 in interest by the time they hit that 15-year mark. The 50-year mortgagee, for that exact same purchase price, down payment, interest rate, but now divided by the 50 years worth of payments, at the 15-year mark, they will have paid $330,000 of interest. And then when we go to the 30-year point, because this is what the majority of people's mortgages are, so they in total will have paid $442,000 in interest. Comparatively to that same 30-year point, the 50-year mortgage person will have paid $603,000 of interest. Plus, they've got 20 more years to go. So again, we're to that $825,000 of interest paid to the banks for this affordable 50-year mortgage. Here's what's crazier, I guess, if you can get any more crazy, right? So the 15-year, 30-year, and we're going to make an assumption that the 50-year loan packages actually don't usually have the same interest rates available to them. The interest rates change. Yay! Typically, the shorter the mortgage term, the shorter the interest rate. If we were to now put these numbers in here, we would cry. So if we did the current, as of the beginning of November 2025, 15-year rate, again, I'm not a loan person, so if the rates are wrong, don't come at me. This is illustrative purposes only. If we put 5.9% in for the 15-year, oh, I actually have another thing too, but we'll get to that. So now, probably would have been easier to do a copy paste, to do a comparison. Hold on. Paste, we want the values. So that just saves it so that it doesn't matter. Okay, so what did we just say, the 5.9, I think it was? I think we said 5.9. Yes, 5.9. So if we go to 5.9 instead of the 6.3, so 5.9, we now have a savings, or I should say interest paid of $183,000 versus $197,000. Obviously the principal stays the same. So $543,000. We're going to see that across the board as well. So why didn't that switch? That should have switched for me. Oh, it did, 5.9. So that changed, so that makes it 667. Anyway, all these numbers are going to change. What's super crazy, I guess, to me is that so let's go to the 50-year schedule, because the 50-year is going to see the biggest difference, because they're going to probably have the highest mortgage rate. So let's go to, say it's 6.8. So right now, gosh, I feel like we got to copy and paste all of this, right? So we don't lose it. Let's go in here. What did we say it was? I already forgot. 6.8. So if we go to 6.8, all those numbers change. The numbers here will change. So, oh my gosh, it's even worse. Let's cry for these people. All right, so right here, this was, we had a currency, didn't we? Yeah, dollars. So we had a $26,000, that difference between when we see what we've paid in interest plus the principal less what the home is in theory going to be worth. We had a net positive of $26,000. In this scenario, it now becomes negative. So you actually will have spent 50 years paying on this house and be net negative $55,000 because of how much you will have paid in interest, because that now goes to $900,000 of interest. And to make matters worse, here's the next thing that's going to boggle your mind even more. I'm going to be willing to bet that we're going to pair some first-time homebuyer incentives. So this 20%, I started off saying that that's kind of where people always assume that the down payment needs to be, but a lot of first-time home buyer incentive packages will allow you to have less money down in the beginning. It just makes it easier to be able to have money down for a home. That's usually could be in the 3 to 5% range. Let's go even at the high range. So let's say we've put 5% down on this home. So that's going to change all the numbers all the way around, different monthly payment, all that jazz. So let's go to this chart here. Oh my gosh, I'm afraid to see this chart, honestly. Yeah, look at this. So with the same purchase price, but instead of 20% down, we're at 5% down, same 50-year loan term, same appreciation schedule. You will pay interest of over $1 million over the 50 years of this loan. And be down basically for $300,000. Now you see why I'm so fired up. Okay. That's all I got to say. That's all I have to say, people. Consult with your lender. And if your lender makes it sound like it's a great idea, maybe find a different lender. I don't know. My guess is it's going to be really glossied up. There's going to be a lot of like, oh, well, it's because most people don't keep a mortgage for 50 years, yada, 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 blah, blah, blah. I don't care. We showed it also at the beginning that you're saving, what did I say? I wrote it here. Now the numbers are going to look funky because I didn't change it along the way. But there was like roughly a $300 a month mortgage payment savings to go to the 50-year. Is it worth it? Is it worth it to be down? Even if we stayed at the original one, you saved $300 a month, and at the end of 50 years, you made $26,000. I don't know. I don't think that's worth it. I don't think it's going to help home affordability. How can I help you make a better informed decision? Comment below, message me, like, subscribe for more.